Stocks finishing the day mixed and, well, up and down. Investors try to make sense of competing currents of fear and hope in the markets right now. Let's find out what this tug of war is going to bring. Let's bring in two of our guests. We've got Todd Harrison. You are the co-founder and you're the chief minion of Minyanville Media. Michael Pento, good to have you with us from Europe Pacific. Glad you could join us today. So what do you make of the market's moves today, Todd? Because when you see what's happened, we get these big run-ups, these bull market explosions, but then the next day everyone has to kind of inhale a little bit and worry, and we don't know where the market's going. Are we still in this range of trading?
I don't know if I would call it a bull market explosion just yet, but the tone is great. Market trades great. It feels great. There's been not break out there. I think there are two drivers. In all due respect to earnings, earnings are coming in better than expected, but the market rallied into earnings. The market's a forward-looking discounting mechanism, so that's baked in the cake. But the two catalysts, in my opinion, are the specter of QE2, or the next iteration of stimulus, and then you have corporate credit, which continues to trade great, but I could argue, as could you, I'm sure, that on either side of that corporate credit you have sovereigns and then you have individuals that are over their skis, so it's all taken with a grain of salt.
Well, it seems as though some corporations are doing better than some governments.
Well, if they sell overseas, they're doing okay. If they sell domestically, they're not doing well at all. Look, we learned today that home prices are down 6% over the last 2 months. We also know that foreclosures are at a whole-time record. So what's going to happen to earnings? What's going to happen going forward here, Pimm? All we have to hang our hopes on is more dilution of the currency's purchasing power. Is that something we really should look forward to in this country? What about savers? They're not even getting an increase in their Social Security checks.
Right, because the Consumer Price Index told everybody, at least coming from the government's perspective, that they weren't going to actually increase the COLA payments from Social Security.
The Fed's own preferred metric, which is this core PCE price metric, says that year-over-year increases were 1.4%. So why can't the seniors who are getting nothing for their checking account, and they've gotten killed in the stock market, and their home prices are down 30%, why can't they get a little bit of an increase in their Social Security checks?
That's actually a great point, because the rub of the whole stimulus package and what we've seen over the last couple of years in the response to the crisis was really that the savers, the people who did the right thing and saved money and preserved their capital, they're the ones who got punished. And I mean, they got more than punished, but I mean, it was really, it's ugly out there. Now they're getting that long squeeze, if you will, back up as the prices go higher. They're getting sucked in by the specter of bigger, better things. But it's going to be very interesting to see how it plays out when QE2 is announced, if it is announced, in terms of selling the news, if that comes to pass, because there's a lot of hope out there. There's a lot of very loud people who are saying it's a win-win either way going forward. And I don't think it's that easy.
So what is quantitative easing part 2 in your mind, Todd Harrison, going to look like?
Well, I think they're going to have to do something unique. I don't think, they're talking about $500 billion, and as crazy as that sounds, I don't think that's quite going to cut it, because when you look at the cumulative dynamic and the interconnectedness of the markets right now, there's upwards of $1 quadrillion of derivatives tying the world together. And just to kind of sidebar the question for a second, when the Bank of America news came out earlier this week in terms of the mortgage gate, if you will, what was interesting to me is two things. Number one, that PIMCO and the Federal Reserve Bank of New York came out on the headline together on Bloomberg, and I thought that was a very interesting statement in terms of where we are right now in this corporatocracy, if you will. Different conversation. But number two, somebody asked me, well, what does this mean for Bank of America? And I said, well, it's not just about Bank of America, because there's no bank-specific problems right now, given the interconnectedness of the derivative markets. So regardless of the number, I think that it's more drugs that mask the symptoms rather than medicine that cures the disease. And I'd be very careful, because the dollar is going to be the toggle here that could potentially be the next
who do you believe, though? Do you believe Treasury Secretary Geithner, that we should have a strong currency? And then he runs over to China and says, please allow our currency to collapse vis-a-vis the yuan? Or do you believe Ben Bernanke, who says we need yet another round of QE, or I like to call it Titanic?
Well, what do you think that quantitative easing, or in your words, Titanic easing, will look like, Michael?
Well, I think it'll be $100 billion per month until the unemployment rate comes down sub 9%. That's my own view.
And will it work? Will it actually reduce the unemployment rate to
raise the unemployment rate to well above 10%, in my opinion, because when you pursue this inflationary monetary policy, what happens is you destroy the middle class. and they end up on the unemployment line.
That's been happening for a long time now.
Well, of course. Look, we're still printing 450,000 initial claims per week. The average was 392 going back to the year 2000. And the private sector growth rate in non-farm payrolls is AWOL. So their plans are not working. And they're worried about being Japan. They should be worried about being Argentina.
So what would you have the Federal Reserve do?
Raise interest rates.
Raise interest rates.
To protect the value of the currency and give us a stable and sound dollar. That's what I would do, number one.
And would raising interest rates have any effect in your mind on the housing market?
I think it would have a negative effect on the housing market. But we need to bring home prices down to a price that can be supported by the free market. We can't continually artificially prop up the housing market. Look, bank foreclosures, bank repossessions hit an all-time high in September. Why is that? That's because we pulled forward so much demand by paying people to buy houses. And now we're telling them that if you're irresponsible and you're not a good citizen, you know what we're going to do for you if you don't pay your mortgage? We're going to lower your principal and reduce your interest payment. But if you're a good citizen and you saved and you're paying your mortgage, you are going to get it where the sun doesn't shine, as they like to say.
What about this idea of raising interest rates,
Well,
Todd?
I got to tell you, I love the fact that I'm not the most bearish guy in the room right now. I do think there are real problems, and you and I are overlapping on a lot of different points, and we have for a long time. And in terms of, I think that there needs to be a free market machination. If there is going to be a free market and true capitalism going forward, you have to let markets trade where they're going to trade. That hasn't been the case for a long time. So I do think there is a very fair amount of validity to that. But we're not talking about, we're talking about the lesser of many evils right now, and it's not necessarily a pleasant message, but it's one that if we can successfully navigate and get through this process with a free market machination intact, and rather than trying to hit the patient in the heart with an adrenaline needle and have them run a marathon, which is just not realistic, then ultimately we're going to emerge from this in a much better place. But you have to go through it to get through it, and we're not being allowed to go through it, and that's part of the problem. And one of the things that really is manifesting right now is there's a big difference between the stock market and the economy. And this is now manifesting through the social sphere. You're seeing a lot of moral hazard. You're seeing a lot of percolating angst out there. And social mood and risk appetites always shape financial markets. It's been that way forever, and it'll be that way forever.
All right. Michael, this whole idea of, let's say, raising interest rates as an alternative to quantitative easing, buying treasuries, buying debt of some kind, does the Federal Reserve really have the power to influence what goes on with the currency, either in a positive way or in a negative way?
Of course they do. Treasury, according to Congress, Treasury controls the direction of the dollar. But it's the Federal Reserve that controls the quantity and the interest rate of the currency. So they have all the control. And they're telling the world that the U.S. dollar is too expensive and they want it to go down. And they're telling American citizens that their purchasing power is too strong and they want it to go down. But here's the problem. Interest rates are at an all-time record low, 2.5 on the 10-year Treasury. But the debt of the nation continues to skyrocket, $13.6 trillion. We've got $110 trillion of unfunded liabilities, okay? And the monetary base, or the Fed's balance sheet, continues to expand. We're going to have another $500 billion in the monetary base, perhaps. We'll know on November 3rd for sure. So how are these this explosive cocktail, how is it all going to work out? I mean, you can't have gold making new highs every week and interest rates making new lows every week. But they're totally antithetical.
But certainly the Federal Reserve and Ben Bernanke must at least have run this scenario through their spreadsheets where they looked at what $500 billion of purchases would do. And if, according to you, they do have the power to influence the value of the U.S. dollar by these moves, why would they do this then?
Well, because they want to rescue the economy by boosting exports. That's their whole plan. But there hasn't been one case in the history of planet Earth where a country has been able to depreciate its currency and boost exports. You know, we tried this against China in 2005, 2008. Our dollar dropped, the yuan was revalued by 20%, and our deficit, our trade deficit with China exploded. Why is that the case? Because everything we imported from China went up, and everything priced in dollars went up too as well. So you don't end up balancing anything but creating more inflation. And that's my next prediction. I had the housing market right. I had the credit crisis right. I said we're going to have a double-dip recession in the United States. We went from 5% in 2009 GDP growth. Now we're back to 1%. You'll see a very I think, a very bad reading on Q3 GDP coming out next week. So what's going to happen next in this country? I think we're going to have a very significant problem with inflation.
Now, Todd, you've traded. You've been a trader for a living. You've had a career as a trader on Wall Street. So would you trade that kind of scenario?
Well, this is the problem. Okay, so. First of all, the dollar is a problem. I'll tell you why it's a problem. Because the world, is holding as a world reserve currency, dollar-denominated assets such as crude and even gold, for that matter. The rest of the world is not participating in the rally to the extent that Americans are, and Americans will say, "Well, why does that matter?" In a globalized economy, that most certainly matters. The other point to that, if interest rates are actually raised, is there is a massive bottleneck right now in the hedge fund community. Everybody's got the same trade on. We're all long commodities, long stuff, and short the dollar. We've seen that movie before. There's also a very large short interest in volatility options right now. So everyone's short volatility, long stuff, and short the dollar. If and when that begins to unwind, not everybody's going to be able to get off the exit at the same time.
I think the technical term is train wreck, isn't it?
Listen, it's crowded.
All right, we're going to leave it there. I want to thank you very much, Todd Harrison, Minyanville Media, Michael Pento,
Thank you.
Euro Pacific
Thank you very
Capital.
much, Ben.
Appreciate your thoughts.